Corporate finance practice problem using Excel. Dividend payout policy analysis. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. We're going to populate that into the blue area on the right-hand side, looking at two different plans or strategies with relations to dividends for a company. We have a 5-year plan, Plan 1 and Plan 2, over the next 5 years. Plan 1 being a more stable plan at the 1.7 in year 1, 1.7 year 2, 1.7 year 3, and then jumping up to 3.1 and 3.1, 4, and 5. Plan 2 being a little bit less stable, starting off at the 0.5 to year 2, 3, and then in year 3, 1.5, in year 4, 3.5, and then the 4.5. So the idea here is to think about, which might be more preferred, say, to our stockholders of Plan 1 and Plan 2. Now, we're going to make the assumption that the stockholders would think that the Plan 1 is more stable, given the fact that you have a more stable run of the dividend policies, which they might perceive to have less risk. And therefore, when thinking about a present value analysis of future cash flows, they might then want a lower discount rate than, say, Plan 2, which has more variance in the dividend strategy, which is often something that people perceive as maybe more risky and therefore possibly resulting in a higher discount rate when you're doing a present value analysis. So that's going to be the assumption that we're going to make, and then we'll think about basically a present value analysis between these two. So the lower rate for the stable dividend plan, less risk is assumed. Let's go ahead and sum these up. If over the 5 year, if we're talking cash flow over the 5 years, if we just add these up, equals the sum of these two items. Let's add some decimals down here by going to the number group, and we add the numbers. We can see that Plan 2 is higher over the 5-year time period than Plan 1. Let's do our present value analysis, however, and then look at our discount rates, where we have the higher rate for Plan 2, given the higher amount of volatility between the dividend policy, resulting in us applying that higher rate. So we'll start with Plan 1 here. I'm going to do it this way. Now note these present value types of analysis, we're going to use present value calculations. If you want to take a look at them in more detail, just the calculation of present value itself, take a look at a prior section where we focus in on that, doing present value with relation to tables, formulas, and Excel. Here we're going to focus in on Excel. If you want to take a look at this type of analysis, take a look at the capital budgeting section where we do similar kind of analysis such as this. But here we're going to use the concepts we've seen in the past and use Excel for the present value calculations. So I'm going to pick up the years here, years 1 and 2, and then I'm just going to copy that down. Let's say 1 and 2, and then I'm just going to copy those down using my autofill. And so I'm going to center that. And one reason I like to have the years over here and nothing else in that cell, so we can use that year in our analysis when we do the present value and copy it down very easily when using Excel or some other spreadsheet. Then I'm going to pick up the plan, which is going to be the 1.7. And let's go ahead. I'm going to select all of these columns and add some decimals. Number group, adding a couple decimals. Then I'm going to put my cursor on that first item on the fill handle, and then drag that down, doing the autofill calculation, bringing that all the way down. So we're just bringing those numbers on down. And then we can have the total down here, same total calculation, equals the SUM, Shift 9 up, and then holding down Control, selecting that range, just summing it up. Let's add a couple decimals there. Go into the number group, couple decimals. Let's put an underline under the 3.1, last one, font group, and underline. Now we'll do our present value calculation. We're going to be bringing each of these dividends back to the current time period to see what the present value of the future cash flows would be using the discount rate at the 11%. So I'm going to do this just with Excel here. This is where you can do the present value different ways. If you're in Excel, this is the way to go. Note that we have these changes that are taking place. Therefore, we can't really use an annuity calculation. We're going to do present value of 1 for each of these years here. Now, note that you could try to use an annuity for like these 3 periods and then an annuity calculation for these 2. But if you're in Excel and you're going to copy this down, it might be just as easy to do a present value of 1 calculation in any case. And we're going to need to do that for the second lineup of numbers because these do not have any cells that are in common. So I'm going to bring this first one back down to period 0 by saying negative PV, present value, shift 9. We'll pick up the rate, which is going to be that 11% down below. Now, when I copy it down, I'm going to want to make that absolute reference. I won't do that yet, but I'll just show you that we would hit F4. We'll come back and do that in a second too. F4, $sign before the B and the 11. So that we're telling Excel, don't pull that down. You only need a mixed reference, but absolute works too, and it's easier. So the number of periods I'm going to say is 1. Notice I'm not hard coding 1, but picking the 1 up in the cell to the left. The reason being that will allow us to copy it down, the next cell then going down to number 2, and so on, allowing us to copy it down without having to hard code the number each time. Comma, we don't have a payment because it's not an annuity. That's only an annuity calculation function. So I'm going to say comma again to get to the future value, which is this 7.1, which we want to pull back to the current period. And if we do so, there we have it. I'm going to go ahead and select all these cells here and add a couple decimals. Number group, decimals. We got the 1.53. Let's do it again for the second one. And after we do it a couple times, I'll copy the formula down. So I'm going to do it again. Present value, shift 9. The rate is still going to be that 11%. Now, if we wanted to copy that 11% down, we'd make it an absolute reference, F4 on the keyboard, or $sign before the B and 11, comma. Number of periods is going to be that 2 right there. Instead of hard coding, I'm picking it up in the Excel worksheet, comma, comma. Future value is going to be that 1.7 and enter. So there we have it, bringing that 1.7 back 2 years after the second dividend payment brings it to 1.38. Let's do it again. Negative PV, shift 9. The rate, the 11%. Let's go ahead and make that an absolute reference. F4 on the keyboard, $sign before the B and 11, comma. Number of periods is now going to be 3. And then comma, comma, because it's not an annuity, but present value of 1, picking that 1.7 up again and enter. So that third one is going to be present value at the 1.24. Let's do it one more time, and then we'll do the copy down function. Equals the present value, shift 9. This time we got the 3.1 at the 4 years out. Same rate, however. The rate's going to be the 11%. If we wanted to copy it down, we'd have to say F4. I'm not going to use the F4 this time just to see that you can calculate it without F4 or absolute reference or $signs. So I'm just going to say comma. Number of periods is 4, comma, comma. The future value is that 3.1 this time, bringing that back 4 years, 4 periods, 2.04. So now let's do this one more time. I'm going to delete what we've done so far and just do it the easy way using the autofill. So I'm going to delete it, do this first one more time. Negative present value, shift 9. The rate is that 11%. I'm going to make it absolute reference so I can copy it down and not shift down this 11% when we do so by selecting F4 or putting a $sign before the B and 11, comma. Number of periods is 1. That one will copy down for us, comma, comma. Future value 1.7. Enter. Now we can copy that one down and it should do what we want, putting our cursor on the fill handle, dragging on down. There we have it. I typically will double check the last one, double clicking on it. Looks like it's picking up the proper year, the proper amount, and the proper rate. So it looks good. Notice that the $signs are here. That's why that rate didn't move down. Equals the SUM, summing this up. There's our present value. And we're going to say font and underline. Let's compare that then to the second policy here. So same kind of thing. Now for plan number 2. Plan 2, 1, 2. Plan to what? Plan 2. Plan number 2. Autofill this one down. Center it. Alignment and center. And then we'll bring in our numbers by saying this is going to be equal to the 0.5. I'm going to select this entire section here and go ahead and add some decimals to it. Number group, adding decimals. Putting our cursor on the 0.5 then. I'm going to autofill it. Putting our cursor on the fill handle, dragging it down. Double check that it's picking up the last one that we want it to. There it is, picking up the 4.5. Looks good. And now we'll just present value the whole thing. Let's sum it up here. Let's go total. We have a total at the bottom. And we're totally going to total it now. Totally totaling, which is going to be the equal SUM, shift 9, and picking up these cells. And then we'll underline it, font group, and underline. Now we'll do our present value, same kind of concept, present valuing. Back on, and so I'll do it just the easy way this time, and we'll just copy it all the way down. Well, let's do 2 of them, and then I'll copy it down. So negative present value, shift 9, we've got the rate is now 15% due to the fact that we have these uneven payments. If we were to copy it down, we're going to select F4, putting the dollar sign before the B and 12, comma, number of periods is now 1, not hard coding it, but putting the cell over here so we can copy that down more easily, comma, comma, future value 0.5. Bringing that back, that gives us the 0.43. Now the second one, it jumped up to $3 in year 2, but we got to present value that back 2 years. So I'm going to say negative present value, shift 9, rate is going to be that 15%, comma, number of periods, and I didn't absolute reference it. I'm going to do a couple of these a little bit more quickly. Number of periods 2, comma, comma, future value is that 3, enter. And then it goes back down to 1.5, which is that volatility, which is the result of us using the higher rates. So let's do one more, negative present value, shift 9, rate. I know I said I was going to do one more like 3 times. You said one more 3 times ago. I know. You said 15 minutes, 10 minutes ago. Okay. So here we go. Number of periods 3, comma, comma, future value 1.5. So there we have it. Okay, so now let's delete these and do it one more time, absolute referencing and copying it down. So I'm going to do it again, up to up, negative present value, shift 9, rate 15%, F4, absolute referencing it, dollar sign before the B and 12, comma, number of periods is 1, and then comma, comma, and the 0.5. Then we'll copy that down, putting our cursor back on it, autofill handle, dragging that autofill handle on down, underlining the bottom number, font group, and underlining it, and summing it up. Sum it up, and there we have it. So now we're at the 7.93. So you can see here that you could end up with a scenario like this where the stockholders of the market might prefer the first series of dividends, even though we have a lower total dividends over the 5 years from a dollar standpoint, due to the fact that the increased risk might result in people basically applying a higher discount rate to the second, more volatile plan. Because you would think if it was more volatile, it just seems like it would be inherently, more risky of a plan, and therefore in that situation they might actually prefer the first plan if you do a present value analysis for that kind of thing and compensate for that difference, which you might consider to be more risky, resulting in plan 1 turning out to have a higher present value calculation than plan 2.